episode 2. Thank you. Welcome to episode 2 of GBBC's educational webinar series, Not All Blockchains Are the Same, powered by Accenture, Algorand Foundation and Digital Asset. This series is designed to cut through the hype and provide a clear understanding of various blockchain technologies, exploring their development, unique features and compliance capabilities. Today's episode is in collaboration with Avalanche, and we will be exploring the Avalanche network, an open source platform for launching custom blockchains for any use case, including decentralized finance, private financial institutions, and compliance-enabled enterprise applications. This presentation today is brought to you by Morgan Kropetsky, Senior Director of Business Development for Institutions and Capital Markets at Avalanche, and Michelle Tian, Senior Technical Product Manager for Avalanche. In her role, Morgan partners with financial services institutions as they operationalize their digital asset strategies, as well as with early stage teams building blockchain-enabled products and services for institutions. Before joining Avalanche, Morgan spent 12 years at Citi. She spent the majority of that time on the institutional FX and macro sales desk, covering hedge funds, asset managers, and pension funds before transitioning to become Chief of Staff to Citi's Chief Compliance Officer. Michelle leads interoperability efforts within product at Avalanche. She serves as the bridge between engineering and the rest of the company. Previously, she spearheaded ESG initiatives and CCAR testing within the capital markets division at Morgan Stanley. I'm going to hand over now to Morgan and Michelle, and I do hope you enjoy today's session. Thank you so much.
Thank you so much, Emma, for having us. Thank you to the GBBC, and thank you for all of you for joining the session today. As Emma mentioned, I'm Morgan Kropetsky. I lead institutional and capital markets business development at Avalanche. Let me start sharing my screen so we can delve in and talk about the Avalanche network. So today we're here to talk to you about what sets the Avalanche network apart from other blockchain options and why financial services institutions in particular are leveraging Avalanche within their blockchain and digital asset strategies. First, let's take a step back and think about what blockchains are even good for. At the simplest, most basic level, blockchains have the ability to provide a uniform language, transaction, and value settlement rails. This concept is especially powerful when you think about the various departments, companies, and industries that operate in their own silos with their own systems that generally don't talk to each other. Because of this, they typically execute processes like those within capital markets, for example, with a lot of manual and continuous reconciliation, delays in confirmations and processing, inherent risks, and added costs. Blockchains provide the ability to bring all of these parties and processes onto a common infrastructure, which enables data uniformity and integrity, transparency, as well as auditability. Add on top of this the concepts of tokenization and smart contract logic, and you have the potential to really create automated asset and value transfer between multiple parties. And once the underlying asset data is represented on chain, smart contract logic can be applied to enable things like automated delivery versus payment processes, atomic variation margin transfers, waterfall calculations, and interest payments, just to name a few examples. Overall, blockchains really have the potential to help upgrade legacy financial services infrastructure and institutional workflows, to increase asset mobility and utility, and to reduce settlement, counterparty credit, and other risks. Now, there are a ton of blockchain networks already out there. Those that are considered public and permissionless, like Ethereum, boast a great deal of activity and innovation with large developer and user communities, decentralized finance ecosystems with deep liquidity, as well as asset and application composability. But these monolithic chains have their limits in terms of scaling and behold everyone to the same network toolkit and logic. Imagine that a time-sensitive FX trade between institutions is stalling because Taylor Swift is releasing NFTs on the same network, and you have no idea how long this will take, if it will actually settle, or what the transaction cost might be. These networks also give up control and compliance, which has been especially relevant for regulated institutions like banks. Given their permissionless nature, anyone can run a validator and affect transactions. On the other end of the spectrum, those networks that are considered enterprise blockchains that are private, permissioned, and deployed in isolation, like a hyperledger, for example, they allow institutions to regain that full control, but literally miss out on everything else. So how does the Avalanche network fit in, and what value does it bring to the table? We believe that as the internet of blockchains, Avalanche is a network of seamlessly interoperable and customizable networks. And so to that end, Avalanche offers the best of both. On the one hand, Avalanche offers public permissionless open source infrastructure. It's a layer 1 EVM compatible network with a top-tier DeFi ecosystem and a robust developer and builder community. It enables on-chain asset and application composability and houses all of the necessary infrastructure and native integrations that are key to a public permissionless network. Some of this includes things like stablecoins, data oracles, custodial and exchange integrations, compliant tokenization platforms, account abstraction tools, wallets, and so on. It's also powered by Avalanche Consensus, which Michelle will get into with some more detail in a bit. But at a high level, Avalanche Consensus allows transactions to be processed inexpensively, especially when compared with Ethereum, and settle in less than a second, which is important in general, but especially for high-value, time-sensitive trades and transactions like those in the financial services industry. On the other hand, Avalanche is not a single monolithic blockchain, but really a network of many blockchains. It allows for custom layer 1 networks to be spun up for a whole host of use cases, industries, and companies. Institutions have the option to own their end-to-end blockchain environment, like those enterprise chains that I mentioned, but importantly, can also benefit from native interoperability and integrations found throughout the network. So before we delve into each of these characteristics, I just want to take a moment to review the discovery of the network. Avalanche was founded by Dr. Emin Gün Sirer, a tenured Cornell computer science and distributed systems professor. Dr. Sirer has been in the space since the beginning of cryptocurrencies. Back in 2002, in fact, he created the first ever proof-of-work cryptocurrency and peer-to-peer electronic cash system called Karma. He also discovered the biggest known flaw in Bitcoin, known as selfish mining, and co-authored a paper on this in 2013. At Cornell, he led the development of the Avalanche Consensus Protocol, which Michelle will get into shortly, and in 2019 launched Avalabs, which is one of the Avalanche network developers and builds infrastructure and tooling to really drive forward the growth and adoption of the network. Even through today, Dr. Sirer continues to be a notable thought leader in this space, as well as an author, lecturer, consultant, and advisor to crypto projects, governments, central banks, Fortune 500 companies, and really everything in between. In March of last year, he was appointed to the CFTC's Technical Advisory Committee, and in June of last year, served as an expert witness before the U.S. House Committee on Financial Services for a hearing on blockchain and digital assets. Now, let me turn it over to Michelle to get into a bit more detail around the technical components of the network.
Thanks, Morgan. That was a really great overview. So now that you have a good idea of what Avalanche is, a network of custom blockchains, let's dive into some of the technical innovations that are developing on the platform. One of the key innovations that sets Avalanche apart is its novel consensus algorithm called Avalanche Consensus, which Morgan has already touched upon a few times. But first, you might be wondering, what even is consensus? Well, consensus algorithms are really just a process by which many different parties come together and agree on something. And to appreciate just how novel Avalanche Consensus is, let's take a brief tour through the various different consensus algorithms. Over the 45-year history of distributed systems, there have only been 3 approaches to the consensus problem: classical, Nakamoto, and Avalanche. In the 1970s, classical consensus was born, and this is a voting-based consensus mechanism where all network participants must vote and unanimously agree on something to move forward. You can quickly see how this doesn't really scale when you add more participants. And so next came Nakamoto consensus, also known as longest chain consensus. This algorithm, developed in 2009, scales better as it no longer requires all-to-all communication. Instead, participants have to solve mathematically complex puzzles, known as proof of work, to generate the next block. But the thing is, this also requires significant time and resources to reach consensus, resulting in higher gas or transaction fees and longer times to finality. And so finally comes along Avalanche consensus, developed in 2018 by Avalabs' own in-house PhD and computer science experts. This includes Dr. Emin Gunsir, Dr. Ted Yin, and Kevin Seknicki. An Avalanche consensus is a breakthrough algorithm that is fast and scalable. It uses repeated random subsampling, a simple statistics concept that involves choosing a random group of computers from your entire pool of computers and then asking them to vote. Is this block valid or not? And it just so happens that when you repeat this enough times, you eventually reach consensus. And this process is extremely fast and highly scalable. It's ultimately how Avalanche achieves sub-second finality, which ensures that transactions are quickly confirmed and irreversible. And it's also how Avalanche is able to have low transaction costs for users. So, as you've already heard, Avalanche is not a single monolithic blockchain, but a network of many different blockchains. This brings me to my second unique feature of Avalanche, which is layer 1 blockchains, known as L1s. You might have previously heard the term subnets, but really you can just think of these as custom blockchains. So with Avalanche, custom networks can be built for any type of use case, industry, or company. How is this done exactly? Well, in traditional computer science, there are scaling mechanisms. You might have heard of vertical or horizontal scaling. These are just different ways to improve the efficiency of your network so you can add more participants without sacrificing performance. Let's think of an analogy here. Let's think about a single chain like Ethereum. This is one blockchain or one tall building. And you can add vertical scaling here with layer 2s or rollups, and you can add more floors to your building by doing so. But you can quickly see how you can only add so many floors and there's kind of a cap. And that's where Avalanche comes in. Avalanche is a network of blockchains. So it's not just constricted to one building, but instead you can have many different types of buildings. And these buildings can come in different shapes and sizes. So you might have multiple floors with massive skyscrapers, or you might have buildings that are really just small houses with only a few floors. And so with this network of blockchains, Avalanche can scale infinitely. Now, just like how different people want to build different types of buildings or houses, companies want custom blockchains that can meet their desired needs. And what's incredible about Avalanche is that anyone, truly anyone, can build, design, or customize their own bespoke blockchain with whatever rule set they need. If you're a gaming developer, a government agency, a payments company, or a bank, you're going to have different reasons for leveraging blockchain technology with different requirements, considerations, optimizations. One common misconception I'd like to touch upon quickly is that blockchain is widely used by criminals because nothing is traceable. Actually, the opposite is true. Blockchains are open, permissionless, and transparent by design. Anyone can trace the flow of assets, which makes this technology actually very useful for compliance. But the thing is, if you're a financial institution, you still might want this transparency, but you might want to limit this transparency to a subset of individuals. Well, good news. Privacy and permissioning is possible on Avalanche. For example, you can create a permission blockchain where only KYC'd counterparties from certain jurisdictions can participate. And you can also add privacy features such that transactions are not visible to the general public, but can be made available to regulators or auditors. Another item that you can customize here is your tokenomics. So instead of being restricted to ETH as the gas token, which is how Ethereum network is designed, you can create your own custom gas token or use a stablecoin, tokenized deposit, or even a CBDC as the gas token. And you can even abstract away the concept of gas altogether by providing a service that pays for the transaction fees on behalf of the users. You can think of this similarly to how Amazon Prime works. Their users don't have to worry about shipping and handling fees, custom and import duties, inventory, insurance costs, and so forth. This is all abstracted away by Amazon when the users purchase their Amazon Prime membership. And then lastly, interoperability. Interoperability is just the ability for computers and applications to communicate and exchange information or data with one another. Blockchains want interoperability, just like how different countries want to trade, transact, or communicate with one another. And Avalanche has its own native cross-blockchain communication protocol, enabling any layer 1 blockchain on Avalanche to communicate with any other chain on Avalanche. Now let's dive a little bit deeper into interoperability. You might be thinking, why would an institution like JP Morgan, for example, want to connect with other blockchains? Well, JP Morgan might have their own blockchain, but they might want to connect to, let's say, the Citi blockchain, where they can send trade RFQs, payments, assets, trade confirmations, or any other message to the Citi chain. Okay, great. So that's why they want interoperability. But the next question might be, okay, why on Avalanche? Well, because Avalanche has native interoperability. And this means that JP Morgan and Citi can send these messages to one another with only relying on their two already known and trusted validator sets. So no additional third-party trust assumptions or bridging providers are introduced. So to summarize, JP Morgan can have 1, their own self-sovereign chain with whatever compliance or privacy controls that they need. They can also have their own gas token, and they'll be protected against another chain's high gas fees because they're going to have their own blockchain. And then finally, number 3 is that JP Morgan can tap into other blockchains like Citi or even Avalanche C-Chain, which is the current liquidity hub within Avalanche that contains the majority of active users. Interoperability is really key here because without it, what even is the point of all of these custom blockchains that can't communicate with one another? So I hope you found this to be a helpful overview of some of the technical developments. This is just a sliver of the many exciting innovations developing on Avalanche. And I will turn it over to Morgan to go over some real-world use cases.
Thanks, Michelle. So I think the various partners that we're working with are really leveraging Avalanche for a variety of reasons that are really specific to each of them and that are ultimately made possible by the various USPs of the network. We're definitely happy to review and kind of go into detail about any of the use cases and applications being deployed on the network, but let me just hone in on a sampling. First, the work taken forward by the Lemonade Foundation entails an insurance-like application that offers parametric insurance to subsistence farmers in Africa. In Africa alone, there are around 300 million subsistence farmers, most of which are not financially protected against risks like floods and drought. And while this is typically where insurance obviously can be valuable, in this part of the world, it's either too expensive or non-existent. In low-income countries, less than 3% of the farmer population ends up getting agricultural insurance. For insurance companies that rely on traditional tools for distribution, pricing, and claim handling, providing climate-related insurance to these farmers often is not considered financially viable. So to that end, the Lemonade Foundation partnered with Avalanche, data oracle provider Chainlink, Hanover Re, and a few others to build an on-chain application to really address this issue. Through the application, farmers get a quote on their phone for insurance, and a policy is created if they decide to purchase it. By parametrically measuring the amount of rain in an insured field of crops and transporting that information on-chain through data oracles, smart contracts trigger insurance claims and automatically pay farmers in stablecoins without them ever needing to actually file a claim. The use of autonomous smart contracts and highly accurate weather feeds collectively has brought the cost of handling claims down to zero. Key considerations for leveraging Avalanche here included the fact that the network enables near-instant settlement, boasts inexpensive transaction fees, supports native stablecoin and Oracle integrations, and is eco-friendly from an energy expenditure perspective. In another example, Deloitte has been working with the Federal Emergency Management Agency, or FEMA, on a platform called Close as You Go. Generally, FEMA helps communities recover from disasters by providing public assistance that governments can request to reimburse their recovery expenses. The reimbursement process can be complex and time-consuming, with constant handoffs and the potential duplication of benefits that ultimately may lead to clawbacks. The Close as You Go platform streamlines the disaster relief disbursement process through a shared accountability platform among the agencies and service providers involved in the process. It helps agencies manage recovery documentation for procurement and contracting, as well as policies and procedures. It enables trust and transparency using blockchain technology, and specifically a customized Avalanche L1, where only authorized parties can securely and efficiently distribute and verify time-sensitive information. Ultimately, Close as You Go is meant to accelerate recovery by organizing documentation to demonstrate eligibility, simplifying retention by storing and linking documentation, reducing administrative costs, and mitigating the risk of fraud. Here, key considerations for leveraging Avalanche included its EVM compatibility and customizability around privacy, permissioning, as well as gas token selection. Finally, let's explore how JP Morgan's Onyx Digital Assets team used Avalanche under the Monetary Authority of Singapore's Project Guardian. In this industry POC, the ODA team deployed an asset management application on a custom Avalanche blockchain to show how a combination of blockchain, tokenization, and smart contracts could allow for seamless portfolio creation and rebalancing for wealth management clients. This really paved the way for alternative assets like private equity, credit, real estate, and infrastructure to be included in individual investment portfolios at scale. This is something that historically has been infeasible given the really operationally intensive nature of administering alternative assets. Making these assets more accessible in this way represents a $400 billion annual revenue opportunity for fund managers and distributors, and something that many are exploring in the partners that we talk to. Ultimately, ODA's solution demonstrated how a wealth management firm with 100,000 client portfolios could automate monthly rebalancing from over 3,000 operational steps to just a few clicks. And finally, key Avalanche considerations here included the network's near-instant settlement capabilities, its EVM compatibility and customizability around privacy and permissioning once again, and the integrations and innovations within the broader network. So really appreciate everyone tuning in and listening to our presentation. Happy to field questions. We also have Lee Schneider, our general counsel, who will be joining us for the Q&A portion as well. So maybe Emma, if you want to stop recording, we can start fielding some questions.